Good afternoon, everyone. Thank you very much for coming along. I think it's probably worth saying that my panel will know a lot more about what we are talking about today than I suspect I will. I am a M&A funds partner at the law firm RPC Reynolds Porter Chamberlain. We're a firm of about 80 partners with offices in London, Hong Kong and Singapore. I think it was Jim O'Neill, the Goldman Sachs economist, who coined the term BRICS: Brazil, Russia, India and China. I think today we're going to try and cover the IMAX, which is India, Mexico, Africa and China, which is a bit of a conflation of countries and continents. And there's an awful lot to cover, because not only are we going to try and cover all of those countries and regions, we're also going to try and cover a number of different sectors, specifically infrastructure in India, telecoms in Mexico, real estate in Africa, and perhaps specifically East Africa and Kenya, and then also media opportunities in China. So there's a lot to cover. We've got a great panel, Bhavik Shah of Nvidia Group, to my left, Lewis Trevino of Beaumont Investments, Julian Marvett of Iridios, and Jack Sevison of the Thoughtful Media Group. And they're going to try and cover off those four respective areas. And what we want to try and do is try and tackle some of the issues around how one sources transactions in those sectors and regions, what the challenges are to doing those deals, what the return profiles look like, and we'll try and pick up some other issues and concerns as the discussion develops. So I think emerging markets are, or at least from where I'm sitting, a fascinating area. It seems to me that it's a very mixed picture. Some argue that emerging markets aren't as strong as they were, with commodities prices being at sort of relatively historic lows, and some other commentators say that China has slowed from 8 or 9% to 5 or 6%. By the same token, I think that there is a massive and emerging middle class in many of these countries, and someone put it to me this morning, once you've got a fridge freezer, you want a smartphone and a 4x4. So I think the opportunities are huge. So with all that in mind, perhaps I could just turn first to Bhavik, talk a little bit about what he and the Nvidia Group do, and specifically some interesting opportunities regarding real estate in Africa.
Sure. Thank you, Anthony. Gosh, what does Nvidia Group do? That's quite a broad question, but to focus it particularly to what the context is here. We as a multi-family office look after families from East Africa and India. And a lot of these families have got, most of their wealth currently in their businesses, which are based out of these regions, in particular East Africa, as I mentioned, and cross sectors ranging from real estate to mining to manufacturing to retail, distribution, and through that network of families that we look after within just East Africa, what we have now is wealth of expertise, contacts, networks, and infrastructure to be able to focus on real estate investments in East Africa. So as Nvidia Group and the family office, while we do look at investments across the globe in real estate, equities and fixed income, broadly 3 asset classes, within specifically East Africa, our interest is solely in real estate, so we don't touch anything in the equities and fixed income space there, especially because the families we look after already have their exposure within those sectors just by being based there. But within real estate, what we've realized and what we believe is that going direct into real estate opportunities, development opportunities, be it in residential, commercial and industrial, which are the sort of more bullish areas in our opinion in regards to Africa at this point in time, as opposed to, of course, perhaps the more exotic and alternative areas within real estate, such as hospitality and education, etc. But going hands-on within that particular sector and having a team in-house gives us that real control of ensuring that all the different risk factors are well covered and mitigated.
So Bhavik, when you're investing in real estate in Kenya or other countries in Africa, are you doing all of those deals in-house, or do you team up with local partners and undertake joint ventures?
Good question. So when it comes to East Africa, indeed we would actually be the local partner because members of the family that we look after are on ground and already have the infrastructure and setup for taking on real estate transactions there. We haven't touched other parts of Africa at this point in time in regards to real estate. And the reason is because we haven't found the ideal local partner in that particular geography. And that brings me back to, I think the key points why, having a local partner is very important in regards to any part of Africa you want to go into. It's one of those things that Niveda as an organization that's got such a strong background from East Africa allows us to be the ideal local partner for family offices and institutional investors from other parts of the world to be getting into Africa. Everything from deal sourcing to structuring the transaction to obviously execution, which is most important, all and up to exit is managed well amongst the team in-house.
I was chatting to another gentleman at the conference who remained nameless this morning, but he was telling me about a situation in Kenya where there was some political risk effectively, and there was an investment, a real estate investment, which might be subject to a sort of compulsory purchase. Have you seen any of those sorts of risks in Kenya? And if so, how do you mitigate?
Yeah, well, it's very rare, and I'll tell you where the trick is. The trick is in really buying good quality assets, and when I say good quality assets, I mean assets that you also know who you're buying it from. Yeah, if you know who you're buying it from, and this is where again the importance of a local partner comes in, who knows, it's a very close community. It's a very small market, and that's the beauty of Africa, and again of cities within Africa. That if you've been in a particular city for a few decades, you know who owns every piece of land around the core, and knowing compulsory purchase.
Sure. Okay. Thank you. I'm going to turn to Lewis next, who's a Beaumont Investments. Lewis.
Hey, thank you. We are a single family office based in Boston. We started looking into Latin America in 2010, 2011. At that point, we decided we are not going to go for allocate through managers in private equity. We are 1.2 billion assets under management as a single family office. 60% of our assets we invest in private equity type of deals, direct deals mainly. At that point, back in 2011, we looked all the managers in the region. We didn't like any of them. So we decided to go direct and start doing our own private equity deals in Mexico and Colombia mainly. Today we have 9 portfolio companies. We have 2 buckets of deals that we do. The first one is low middle market direct investments, private equity type of deals. The second one is direct lending to the middle market. The topic that I'm going to talk about is the telecom opportunities in Mexico. In the last 3 years, Mexico had 2 main reforms: oil and gas and telecom. The oil and gas, they are letting enter to private investors into the Pemex, that is the state-owned oil company. And the telecom reform is based in break the empire of Carlos Slim in Mexico. American Mobile control 70% of the cell phones in the country and 80% of the landlines in Mexico. So what this reform is about is to let new players enter into the market, allow foreign investment to invest in this industry that was banned to have a foreign investor majority in a telecom company. So what we have seen, and we have been playing in this space for the last 2 years, trying to figure out how can we get exposure to the telecom without have to invest. You know, we are a single family office. We are not Vodafone, or we are not, and our background is not just in telecom. We are really diversified in terms of industries. So just as a little of background, AT&T just bought the third and fourth largest cell phone companies in Mexico. And what we have seen, and we have going deeply into due diligence in the industry, the publicly traded companies, and look the ways that we can extract value for our family office out of this reform. And we have been investing heavily in service providers around the big companies. Virgin just opened as well operations in Mexico with Temasek, that is a Singapore sovereign fund. So it's a market that is moving a lot of new players are coming. This reform to have effects in the market is going to take 3 to 6 years, where we are going to be able to see that 70% of Carlos Slim American Mobile is going to go down to 40-30%, and new players are jumping in. And we believe that it's a great opportunity to capitalize on that based on service providers, direct lending to those service providers, because obviously these companies are going to require to set up new infrastructure.
And Lewis, from hearing you talk, it sounds as if the investments that you're targeting are direct investments into companies that service the main telecoms companies in Mexico. So typically, are those deals that you're looking at, are they deals to provide debt or equity, and what are the typical returns that you're targeting?
So we do both. For example, we're working, we just closed a transaction as an equity play when we bought a minority stake in an IT company, exited some guys who had like huge contracts with AT&T now to do IT related jobs or contracts with them. And that's a pure equity deal. And in the other hand, we are trying to close another transaction where we are taking contracts actually with Virgin, put it into a trust and finance that and have the cash flows, like project finance. Typical returns in debt is high teens, low 20s. In equity, it depends. Average is like mid 20s, maybe 30s, low 30s.
So the debt return sounds quite high to me with the UK has it. That sounds like a mezzanine coupon.
Exactly, and that's average. The returns that you should be targeting in debt in the whole region.
Yeah, and certainly in the UK, I mean, we've seen a big deregulation in the telecoms market, and the number of big telecoms companies are probably going from 5 to 4, and they're all trying for the quad model, as I understand it, which is TV, broadband, internet, and the other one I can't remember. Is something similar happening in Mexico?
Yes, so the main competitor to Telmex, that is American Mobile or Carlos Slim, it's a company called Televisa, that they were a TV, they're actually the largest providers of TV content in Spanish, and they moved just to be a TV network into a cable company, and they are bundling like cell phone, internet, landlines, and of course the TV.
And the other thought I have is that, again, in the UK you're seeing, we certainly have a number of clients in the tech sector that are very much based on cloud technology. So they are leveraging off the cloud to provide cloud-based services to a telecoms company, for instance. So you see opportunities around cloud-based companies in Mexico?
I think Mexico is still far from that level of sophistication. I think it's a really broad play that is going to be just cell phones, landlines, internet access at the moment, and that's where we see that we can extract more value rather than go to more services, technologies at the moment.
Great. Okay, thank you. That's fascinating. Julian, if I could turn to you next.
Yes, sure. I mean, myself, I'm from a German family office. Myself, I'm now in the ninth generation. Originally, I've been into sweets and confectionery in Masterplan. Maybe some people know this kind of candy sugar element. And then we basically diversified completely into real estate. So we sold the shares and then got into real estate, got into different European markets. Going typically into commercial, residential. Quite recently, through me, like we have also a bigger theme of energy efficiency. So we are decreasing energy costs, and we even have a pool of engineers who are doing that for also external clients as well. And then now coming to the emerging markets, we started throughout Europe. So Germany was obviously our predominant market, and then also some other European states, but we thought also about like opportunistic markets. And in our analysis and in our approach, we really liked India. So therefore we were focusing on that market, very much on affordable housing, because obviously you cannot enter that market with a typical building in terms of structure in the same approach as in Europe. So we thought it was quite interesting because there's a proper need for housing to deliver a solution which is affordable for the people there, and at the same time delivering good quality, because at the moment there are a lot of Chinese providers out there who are not only in India but also in some African states, and they're delivering quite poor quality. So after 3-4 years, like the cement structure is basically destroyed. So we're working together with a German provider, good engineer work in that sense, and have done quite a few projects now in India where we build units up from 200-300 units in one project, and kind of building a little kind of district in that way. The interesting approach with it's not only focusing on real estate, like we have rather like an approach where we lead everything together, so also the infrastructure piece, water provision, food provision, so that you can actually have a kind of functioning city in itself. Because the problem is, and that is happening in all emerging countries, there are a lot of developers who are just providing the units and then leaving, and then you don't even have roads. So there was no life possible really, because that would miss them. So we come from a very holistic approach in that sense. And then also we see ourselves, we're having an impact, we have a social impact, but it's not purely kind of a philanthropic approach. We still do that with mortgages. So basically the people who are going into the affordable housing schemes, they come up with mortgages sometimes up to 30 years, but in that case they can actually afford it to get in there. And we have a return which is much lower obviously in Europe. So for us it's still like kind of a little obstacle to get into the market, because you would never expect like a similar return as in more mature markets, but we really see the potential of it coming up. And maybe to give a little background about India, this country is still booming a lot. Just recently at the World Economic Forum in Davos, it was the second biggest delegation. That hasn't happened before, so China was number one obviously, but like the difference is decreasing. So you see a lot of competition now between China and India as well. And India is getting more to a developed state in that sense that they have a coordinated approach. So before the leadership change with Modi, obviously, you still had a lot of struggles in terms of intransparency. Corruption was obviously a big theme, but that is getting better now. So basically, after the elections, there was this big change. So we were there before that time, but after that it really developed in terms of that many international investors are now getting into, feeling more comfortable in that sense, and able to conduct valuable business cases. Key part, as with BAVIC, is local partners. So you could never really operate without having like a really trusted partner in that kind of environment. We've done that with people which we knew for quite a while, who are Indians, who are local there. Otherwise, I would still say it's a big challenge to do that. And then after this leadership change, also the focus changed. So for real estate, it's now a perfect time. Just this morning.
By leadership change, do you mean minister?
In terms of that, it's more friendly towards economy. So before it was rather unstructured in that way. And for example, this morning there was just the announcement better interest rates. So there's a lot of movement in that way. There are still obstacles in some other sectors. That is to be admitted, but for real estate, it's quite a beneficial area. And then another thing in terms of politics, they put the smart cities on the agenda. So they basically want to create a lot of new cities, because the population growth is obviously one of the triggers which actually convinced us as Germans also to invest into India. Because in Germany the population growth is much more decreasing. So in terms of future potential markets, it's more interesting new developments to go into these markets. So I think that's also one common theme for every developing market, that you have this strong backup by the population, which will trigger the real estate.
I don't want to sound too undemocratic, but of course when you look at China and its ability over the last 20 years to have shifted hundreds of millions of people from the countryside into cities, it seems to me that could never have been achieved but for the government's ability to operate a top-down, very centrally planned programme. In India, with all of its different layers of government and its bureaucracy, does that present a challenge in terms of actually trying to complete some of these affordable housing developments?
It's certainly a challenge in that way, that you cannot move people as easily as in China, but I think people in India are more willing to change. So there is a broader class of people who want to go into cities. They're also quite clever people as well. So if you look into engineers and software engineers, there are a lot of people who have these aspirations to go into cities to develop themselves and to develop business there. So you have rather like this differentiation in that way, that for these cities there's coming a creative class really, and this is driving up the economic growth. And for us as investors, it's also a good sign, because obviously we want to invest in developments where you have also people you can trust in terms of mortgages, and that can only be done if there are like proper jobs and employment as well.
Which cities do you particularly like?
So for us, we have looked quite a lot in the region around Delhi, so not Delhi itself, but Gurgaon and Noida. These are like kind of the satellite cities there. There was a lot of development going on at the moment, but also in southern regions like Bangalore, and also the states of Tamil Nadu, which is kind of the growth state of India in terms of economy. So very much looked at economic clusters in that way.
And typically when you're undertaking one of these developments to say build 200 or 300 affordable housing units, are you in conjunction with your local partner buying the land, obtaining the planning permission, developing and then selling? Or is there any emerging model to hold and rent units, which is what we're seeing quite a lot of, particularly in the UK?
Exactly. So like there's definitely more potential also for the rent model. So especially with this mortgage model, it's quite beneficial in that sense. And we very much like to stay involved. So also in terms of the community approach, that we don't only deliver the building structure, but really see that the community is forming themselves. So in that way, also the whole approach is kind of modeled like this. We bring in the knowledge in terms of the cement structure, but then like the people, the local subcontractors actually have to fill in the cement into the molds and build it themselves. So like getting them kind of the ability, the perspective to develop that then by themselves. And I think that's really important because that's really our added value. I mean, except giving the finance, obviously, we also want to bring in something which would enable them to grow in that sense.
Great, thank you. Jack, if we could turn from India to China.
Sure. Well, we are not a family office. We're a trading entity that actually is based in the United States, but started witnessing a trend taking shape in the emerging markets that was following an already well-trodden success story in the form of digital media, specifically YouTube. YouTube generated an opportunity for ordinary people to turn their life experiences into very lucrative events. 1.7 million people right now earn a living on YouTube, making videos with their home video cameras and effectively consigning that media to YouTube to sell. We saw this trend and it was quite remarkable, but as digital media began finding a foothold in other parts of the world, we decided that this trend was likely to move and migrate very rapidly to the emerging markets, specifically to the world's biggest video viewing market, which is China. Last year, in 2014, there were 2.8 trillion digital video views watched around the world. 1.3 trillion of them came out of China, which doesn't have a YouTube. It has 7 versions of YouTube, and YouTube and effectively all Google products are banned there. So we set up shop there in 2011 and began trying to cultivate the trend that we saw happen in the United States and play well out over the past 6 years. And today it is following in lockstep, especially in China, but in all areas around China, Thailand, Vietnam, Indonesia, the Philippines, and even Myanmar is now starting to show signs where this global consumption of media is taking on a whole new form.
And how do you, well, I suppose 2 questions, how do you monetize that? And for the audience, how is what you do potentially of interest to, say, a family office that is looking to gain exposure to that sector in China?
Well, a couple of reasons. Number one, the story's already played out in much of the Western world, right? And the conditions are very, very similar, with the exception of in China, because you have these heavily weaponized versions of YouTube that are run by... Yeah. Well, you've got Alibaba, which now owns a fairly healthy chunk of Youku and Tudo. You've got Baidu, which owns Aichi and PPS, which are giving Youku and Tudo a run for their money. You've now got Sohu and Tencent, and these companies are not going to cede any ground to one another for a very, very long time. Nor are they up for sale to one another. So you're going to have an all-out media war in China, which is going to be paying a handsome reward to anybody that is going to contribute to the bottom line of views in terms of winning this war. And we saw this playing out a few years ago, and now it has absolutely reached a full tilt. So you're seeing month over month growth in this category of greater than 40%, and we estimated that number would be closer to 8%. But there's no sign of abating. We just witnessed, Chinese New Year. We normally expect to have a 50% drop off in all of our traffic, and we actually saw a 10% uptick, and that's not because there were more people that suddenly, decided to not go on holiday. There were just the volume and velocity in this space is so overheated at the moment that it's not likely to abate for some time.
Yeah, we were talking before we came in, I think you put it in terms of the Alibaba effect. And certainly in the West, we've seen YouTube, Google and Apple just buying up all sorts of technology companies at vast multiples in order to gain traction in specific subsectors.
Yeah, this is kind of a look back at what happened when Google went public and had all of this cash. Suddenly you were seeing big and small and medium-sized companies all across Silicon Valley being picked up. Today, the Alibaba effect is also having that same foothold, where you're seeing these companies that went through their Series A round and they're suddenly gone, right? And there's not enough deal flow right now to match up with the amount of money that Alibaba wants to put to work to gain market share in every sector. And remember, this is a company that has 3 million people that sell things for a living every day on their Taobao platform, and that are beginning to use video as a tool to sell it. So you've got the rise in social media in China is likely not to slow down for any time to come.
Okay, thank you. So, by the way, I should say, if people in the audience have questions that they'd like to throw at us, then please do put your hand up, because I'd be keen to try to open up the discussion. We're obviously trying to cover a lot of territory, so hopefully some of you will be interested in some of these sectors and regions, and we'll have some questions to pose to our panel. But just one general question from you. In any discussion about emerging markets, there is always a significant concern over political risk. All of the countries and regions that we're talking about are very different, but they will carry with them legal, political, regulatory risk. And so just running through the panel, is there a particular concern that you have from a political, regulatory or legal perspective when you're structuring your deals? What's the one thing that keeps you up at night?
I should say one thing, of course, that the regulatory framework, when you look at any African country, is still not fully developed. And the good news is that it is developing and it's in progress. On a regular basis, you do see improvements in the framework, but you still do have that particular challenge. But the idea is to work with that challenge in place. You know you've got that restriction, you know what the implications of those particular challenges could be, and the idea is to work around it. So for example, when it comes to structuring deals, for example, of course there are ways, especially when you're looking at investing into Africa, of having the sort of, I would say, the primary structure being based outside of the jurisdiction you're looking to invest into. Picking some of the more popular jurisdictions, for example, with regards to investing into real estate in East Africa, you look at Mauritian structures being something that's suitable. And what it does is obviously allows you to...
Which is similar to India.
Yeah, that's exactly.
Exactly, true. And of course, when it comes to, again, on the ground, policies which might be very specifically impacting your venture, your project, your investment, what you have is the ability to lobby with the government, with the policymakers on how they could bring about the relevant changes you require, if you believe, and rightfully if you believe it's the right thing to be done. So we've been involved in that in regards to investments again within the real estate sector, mining, within the manufacturing sector, where we've had to actually work with ministries locally within East Africa in specific, to, and in particular I'm referring to Uganda and Kenya, two countries where speaking with the local government, government ministries, actually allowed us to get whatever we needed to be done in a meaningful way, not choosing the plan B option, which obviously isn't the necessarily the best way forward.
Yeah, and where's your exit for these transactions?
Where's the exit? Good question. It depends on the size of the the project that we're actually involved in. If it's a commercial development, something that's got a AAA tenant in there, then exits are fairly easy because you've got pension funds, insurance companies, institutional investors interested in taking a chunk of that. One of the challenges we are facing at the moment is in, I would say, assets which are larger than large. So I'm referring to those which are for example, in Nairobi, but they're more than $500 million in value, a single asset. And how do you exit out of this? Now, you might think perhaps it might be, there might be scope to set up a REIT sort of a structure there. But the problem with a REIT in Kenya is that the regulatory framework actually contradicts in a particular section within it with regards to the role of a REIT, as we discussed previously. So that's again where we now having to lobby with the government, sort of helping them understand what the purpose of a REIT is and what their traditional thinking is that a REIT's used for development projects where you can have investors putting in small amounts of money and buying a piece of land and developing it. But what they need to understand is REITs are more useful when you have income generating assets. And it might seem trivial and basic, but it's something that again you've got to get down and accomplish on ground together with.
To my mind, it's fundamental to trying to achieve an effective exit.
Exactly. But that's for the commercial. But again, when it comes to residential assets, housing, you've got absolutely no shortage of buyers for those from the market locally there. You've got middle income sector rising. You've got so much of rural to urban migration taking place, and so there's always demand for those units.
There is, from your perspective, what is keeping you up at night in terms of your existing investments?
That's a good question. I think in Mexico, we have seen in the last 10 years that the legal framework is changing to a copy of the US legal framework. It's pretty similar now. 6 years ago I introduced a new bankruptcy law that is pretty much Chapter 11 and Chapter 9. So in that front, I think it's not like 20 or 25 years ago. I think that the legal framework is there. Of course, sometimes the hard part is to execute the legal framework.
Yeah, that's horrible.
You might know that more than me in that, but in the case of the reforms, the oil and gas and the telecom reform, I think they already have the reform. The hard part right now is to get the secondary laws or the rules that are going to be in place to let players jump into the market or execute the reform.
Sure. Julian, do you have any thoughts in terms of the things that really worry you about your existing investments?
I mean, if you look at India in specific, I have basically two major concerns, which are coming more from an external space. So there is definitely a large tension from India towards some neighboring countries. So I like myself a hands-on approach. So I was also in Kashmir in the military camps to the border of Pakistan, but quite interesting enough to the border of China as well. So some people are even not aware that the border between China and India in that region is not defined either. So if that tension is going on more and more, you could face serious trouble in that region. And that is obviously affecting in some trigger-down effect also your investments. So I was quite cautious in that way and was also like having my own impression towards that development. And that is definitely still worrying because there's not yet any development trying to kind of calm that situation. Second thing is the health situation in India. I mean, the hygiene situation is still not yet a slide of a mature market. And if you look into the situation of Africa, I mean, hopefully that would never happen, but just imagine Ebola is coming to India. You would face a serious threat in a very short time for the whole country, basically.
Yeah.
So in these terms, kind of like unsure accidents could definitely be a risk.
Yeah, pandemic risks. There was a conference this week on Ebola that I was reading about, where I think they concluded that despite the fact that Ebola seems to have almost been limited from Guinea, Sierra Leone and Liberia, almost seems to have totally dissipated now. They concluded that there are 30 countries in the world with health systems less developed than those countries, which, if you think about it, is a pretty terrifying prospect. Jack, any thoughts on this?
China's a different situation altogether, right? President Xi Jinping has enacted a series of very tough reforms that are aimed at really getting China into a state of modernity that it hasn't seen so far. The first approach that they took was anti-corruption, right? So they made it very challenging for government officials to keep those houses that they were, handed in Europe, and there have been numerous arrests that have shut down the status quo in China. That is really meant to make China more friendly to investors. And there's a lot of investors that are looking at China now and saying, wow, we don't know what to expect, because compared to the last administration, this one is much tougher. And they are certainly tougher with Western influence in the country. We have seen that. So far as I can tell, that really extends more to Western influence that is likely designed to be anti-government. China's a really easy place to get along with if you follow the rules. And we, as a rule, follow through rules very, very closely and very strictly, especially with media. I mean, it wasn't 2 years ago that Sina Weibo was the social square for all of China. It was everything. It was, from a technology standpoint, you could liken it to MySpace versus Facebook, because there has been a shift from Sina Weibo to Weixin, which is WeChat, an open network to a closed network, which the China government dramatically prefers. But what led Weixin to become so popular was that China decided to crack down on Weibo. It did not like the idea that there was a social square, and there were a lot of people saying a lot of things with growing voices that the Chinese government didn't like.
Well, what do you mean by the social square?
Well, so Weibo very much was an open network, like Twitter is, right? You can follow anybody and you can read anything from anybody. You don't have to be a bi-directional friendship in order to read what it is that they're saying. So it was very open square, and when there was dissent in China towards various activities that the government was a part of, or that government officials were part of, that sort of was leading to actually this anti-corruption campaign, it took place on Sina Weibo. And the government imposed a law immediately about libel, and it threw a number of people in jail just because they had said that what they had said was libelous. It was certainly slanderous. And what that led this huge social community to do was close it and not say anything anymore, because they were worried that they could be wrapped up in it. But China is much less scary than it appears to be, because they really just have a couple of very specific purposes, and by and large, if you follow those rules, you're okay. It's a very stable place, despite the recent shifts from this administration. I think they were designed to make the country a more investable country.
Fascinating. We've got about 10 minutes left, I think. So I'd like to try and invite the audience to ask some questions. Is there anyone that has anything pressing that they would like to ask? I'm not seeing it. One hand, thank you.
I know the company, I've been involved with them, but could you explain what you're doing to empower young people in these developing regions?
Yeah, so...
And how they're getting an economic sort of independence from this?
So it has been quite astonishing to see what happens when, because social media is ubiquitous around the world now, and it behaves identically in most countries. Right? A young person with a personality and a point of view can attract thousands, tens of thousands, and even in many cases millions, and in rare cases tens of millions of people to follow and to do what those people are urging them to do, whether it be go see a movie, choose a particular brand. And marketers these days are paying handsomely for that influence. And as more and more of these, we call them creators, gain more influence, they make more money. We have a creator, this was just a recent story. I was in Thailand opening up our office there this past week. And one of our creators there had been working in a supermarket, making the equivalent of about $400 per month, which is an average wage, a pretty good wage. And he had a pretty decent following on YouTube that he wasn't monetizing, and he hooked up with us, and last month took home a paycheck 7.5 times his best paycheck at the supermarket. And he then has enabled 30 or 40 other people to do this. So it does have a high tide effect, and that effect is taking shape in China and everywhere around the world. I'm not sure what it says about our society that people might be leaving their school and their job to go become famous, but there is a ubiquity about this.
That's a different
this
point.
fame.
I know my 8-year-old son is a massive fan of, is it Stampy Longnose?
It probably is. I've got a 9-year-old. I have to ask him.
The guy that does all of the Minecraft.
Yes, I'm sure that sounds familiar.
And he's now a multi-millionaire, so if any of you haven't seen his videos and are a fan of Minecraft, just Google him or enter him on YouTube. So I think that's one example of empowering young people, but presumably in terms of certainly affordable housing in India, or is it all affordable housing, the investments that you're involved in? What does affordable mean in the context of a typical Indian city?
In India it is certainly, because we decided that's our personal approach to enter that region. Affordable means really in terms of it is not for free. So a middle income class can afford to live in a house, because at the moment the problem is still there are a lot of people out there who don't have proper housing at all. So
Sounds a bit like London.
and actually it's true. I mean, we are laughing about it, but Boris Johnson just recently mentioned that there's a big percentage of informal settlement going on in London as well.
Yeah,
so
seriously.
obviously not slums as in India, like to be seen, but if you look into all the backyards of London, you have sometimes like small kind of cottages built up where people are living. So it's a serious problem here as well, absolutely true. So affordable housing you could even transfer it here as well, and there's obviously also the scheme in place where sometimes for new developments in the UK you even have to have some certain percentage of affordable housing. So it is meant to be very cheap, still good in quality, that people can live there for a certain while. It's not temporary. I mean, that would be another solution, just to have it for a certain 5 years. The cement structure is coming in as in kind of a Lego system. So the walls are already prefabricated, and you can build them up just like as I are already. So quite easy in that sense for local subcontractors, that they take it and build up proper housing out of that.
Sure. Let me just ask another question of the panel, which I suppose is about availability of credit. We heard from Sir Howard Davies this morning about the impact of financial regulation on UK and European banks. I know from my own experience that many of the clearing banks, the mainstream lenders in the UK and in Europe, have retrenched from lending across a whole series of markets and sectors. And that has triggered, in some sense, the rise of the debt fund, the alternative lender, who has stepped into the breach to provide debt capital on all sorts of transactions. When you're looking at structuring deals in Mexico or India or China or any of these emerging markets, and you need to source debt capital, you want to leverage the structure to say 50, 60, 70% LTV, whatever it is. Is there a surplus of debt capital out there? Do you have any difficulties obtaining debt at a reasonable rate and margin? Anyone who wants to take the question first?
I mean, for us, it's not that hard because we have a track record and we can source the money in the US, even through our relationships with the US banks or with other sources of capital. In terms of in-country, I think we can charge double digits because there's a lack of financing and pretty much it's an inefficiency of the market where banks are not lending to middle market companies, something similar what is going on right now as well in the US. That's why alternative lenders are having a boom. I don't know in other emerging markets where, especially finance companies are having a boom of double-digit returns because the banks there are not lending money. So in the case of Mexico, yeah, it's a lack of financing for projects.
Okay.
Yeah, well, the difficulty we face is not with regards to getting the debt finance. And again, it's very much linked to the fact that having a track record. But it's actually whether we borrow in the US dollar or do we borrow in the local currency. And borrowing the US dollar, if I was again big, I suppose Kenya is the example, you could probably get US dollar borrowing there at around 7% per annum for development funding, where you buy the land and all the development funding will then be coming from the lenders. Or if you were borrowed in the local currency, which is a shilling, you'd be borrowing at about 14, maybe 15% per annum. And so there's this massive spread of 7.5%, 8% on an annual basis in terms of how much you'd be paying extra if you obviously borrowed in the shilling. But of course, on the other side, you've got to look at the currency risks and how perhaps if you've got a AAA tenant who is going to be paying you in the dollars, you could then match it against your borrowing in the dollars and hence, mitigate part of that currency risk. But I must also admit, very much what Luis mentioned is the rise of the alternative lenders. It's a very thriving market again, even in respect to Africa, throughout Africa. You've got private lenders as well, even small shops, effectively who a couple of families, if not just one family, who's got the substantial capital, which they would be happy to lend. They wouldn't necessarily need the first job, they'd be happy to go with second, so like there's funding. And of course the rate that they would actually charge would be higher than what the local banks would offer, but would still be available quite easily. So there is this currently a boom of leveraging investments, be it in real estate, be it in any sector, even for businesses for that matter.
Yeah, I'm just interested to hear from the audience, maybe a quick straw poll for those of you that represent family offices. How many of you, perhaps you could just put your hands up, how many of you are considering investing into a debt fund or that sort of structure, or have invested? Is there anyone that is willing to say whether they're looking at that investment strategy? Well, either it's not very popular or there's a confidentiality. Okay. And Julian, from your perspective, is there any issue in terms of...
So we're not so much into debt financing, especially in these cases with India, because obviously the amount of investments, even for 200 units, are not that high as for a proper large development in Europe. So in these cases, we rather prefer to invest directly, having the local developer there. So rather stay over here.
And just one final question very quickly, which is, as we've only got a few minutes left, but any family office will have the opportunity, be presented with many opportunities to invest into third-party managed funds in order to gain exposure to a particular sector or region or both. What's your individual take on investing into funds? So, I mean, for instance, in Africa, you've got an Actis or a Helios. What's your view on funds and alignment of interest?
Sure. We had a chat earlier on the phone, of course, Anthony. From our perspective as Nevada, we very much like to go direct because we like the fact that we've got a lot of the risks managed in-house. Funnily, the people who Actis and Helios actually work with on ground on the development management side are exactly the same people that we work with. So it sort of gives us the same sort of I suppose, on-ground expertise that you would get going through a fund that we get through going direct. The benefit we get, though, I must say, is from a liquidity angle, and because the sort of probably more of a feedback that or other experience that we've had in terms of investment, we found some of the larger funds to be less liquid, finally. With regards to their exits on investments out of places in Africa, then if we were to go direct, no one understand exactly what our exit's going to be, and perhaps because the assets that we're developing are smaller in size compared to some of the larger funds, we find it probably a bit easier to get an exit on those particular investments.
More direct than...
That's right.
Jack, I appreciate that's probably not a question relevant to you, so apologies, but Julian...
So from our side, quite similar. We don't prefer funds really much, so have done quite a few deals normally only doing pure direct deals. I think the critical question is like, if you're not able to secure a trustful developer by yourself, maybe it could make sense to take a fund which has actually this established connection. So if there are a fund who has like perfect trusted people in their country and you won't get the access from whatever reason it is, then potentially it could be quite an easy stream access towards that. But but still, yes, exactly, fees are involved, and then still you have to trust obviously the fund, they have chosen the trusted partner. So in terms of risk in decreasing, it's still much better to have this direct access to the developer by yourself and feeling trustful in that way.
Yeah, I agree. I think all depends of the infrastructure that the family office have in place to execute deals. In our case, we have the capability to go and do direct. I prefer to say the 220, at least that 2% safe. When we go to geographies or places that we don't know, we prefer to partner with local family offices. We are really active co-investing with other family offices in other countries. We also, a lot of families co-invest with us in the countries that we go direct. And again, all depend on your infrastructure. I agree with you. If you can execute. If not, you have to go through a manager maybe first time to learn the country, to learn the industry, the asset class. Well, it might be worth it to pay the manager fee. If not, we prefer to go direct as well.
So, sounds like a pretty unanimous vote in favour of direct rather than funds. And on that note, I think we have run out of time, and I think the panel members will be here afterwards if you want to ask any more questions of them. Thank you.